Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 90. On today's episode, what are we going to talk about? Is there a banking crisis we can talk about? Oh, there is. There is. Let's talk about the Silicon Valley Bank crisis, how these things happen, and what it means for you, your portfolio, your savings account, all these things. We'll talk about banking regulations, how to protect your individual bank accounts, and really how these things kind of happen and transpire. Hopefully I can shed some light on this for you and kind of take some of the confusion out. So get your mind right and let's get to work. Okay, well, welcome back to the show, everybody. Appreciate you being here with me today. Let's just do a general market check. We haven't done that in a couple of weeks. Had the interview last week. And so you look at, we'll get to the banking crisis, Silicon Valley Bank in just a minute, but you look at just kind of where the market is overall. The Dow Jones is actually negative for the year right now, 3.88%. The S&P 500 is still holding on to a little gain for the year. It's at 2% for the year. And the NASDAQ is for now, the big leader at 11%. We'll talk about that in just a little bit. And so you look at the market over the past couple of weeks, we had a really good January, and February was not a good month. And then we've kind of had some turbulence here in March. And so we just look at kind of what's happening here. And I just want to educate you on just kind of the banking business in general. And so when you have this Silicon Valley Bank, obviously, not good that it went down, second largest bank failure ever. And you look at just kind of the repercussions of this, and we'll talk about some of the things that they did that got them into trouble. But I've noticed like there's been some viral videos that have been going around of people just looking at like they show up to a bank, they ask for money, the bank tells them they don't have that much in cash, and they sit there and freak out and say, well, how do you not have my money? You should be able to give me this. So just to give you like a general education here on how the banking system works, there's not I think some people, they put money into a bank and they think that the bank, has a little bag with their name on it that they keep in the vault. And, they just wait for you to come back in and they take a little bit of your money out of the bag and give it back to you. But that's just not the way it works, especially when you look at the different banks and the branches that they have. Each bank branch, it usually only carries so much cash based on kind of how busy that branch typically is, and then also the day of the week, and then the time of year. And so banks get deliveries every week of cash, and it's basically based on kind of what their general activity is. And so obviously towards the end of the week, especially if it's a payday week, right? If it's all around the 15th or the 30th, or just kind of in general Fridays when people get paid and they might come cash their checks, there's going to be more money in there. And so if you have somebody that comes in and it's not kind of a normal deal, or it's after they've already given people a lot of money, they might actually not have the money that you're requesting, or the denominations, right? The type of bills that you want, 20s, 100s, whatever it is. And so I worked for a bank for 7-8 years. And, around Christmas time, obviously, we would carry a lot more cash. There's a lot of people that come in, they ask for more cash than normal. They want to put it into envelopes and they want to give it to their kids and their grandkids or whomever. And so there's just different times of year that banks have more money or less money depending on what's going on. And so, and the other reason that banks don't keep a lot of cash is the liability perspective, right? If people knew how much each branch had, they're more likely to get robbed or whatever. So when you look at Silicon Valley Bank, you basically have kind of a good old fashioned bank run. And so Silicon Valley Bank, there's a lot of intricacies with this that we kind of need to break down just to kind of have a general sense of what happened. Because when you hear about a bank failure, Obviously it's a scary thing. There's not many things that are more emotional to people than their money. People want to make sure that their money is safe. They want to make sure that when it's there, that it's needed. And so we kind of need to talk about duration, bond duration. We need to talk about FDIC insurance and what that means. And then also just kind of how you can protect yourself. So FDIC insurance, Federal Deposit Insurance Company, is something that each bank around the country pays into, right? When you think about its insurance, right? So you think about your car insurance, you think about your house insurance. Every single bank is making payments into this insurance company for FDIC so that if a bank does fail, there will be money available for depositors. Right, this is something that happened after the 1900s bank runs when banks failed. It was established back then. And basically how it works is it says that every account up to $250,000 is insured. So let's say your account. Let's say you're married and your spouse has an account, and then you have a joint account together. So your individual account could be insured up to $250,000. Your spouse's account could be insured up to $250,000, and then you could have an account together that's insured up to $250,000. So just right there, you could have $750,000 worth of insurance between those accounts. And then if you look at investments, there's SIPC insurance, which covers way more, up to most cases around $50 million of insurance. And so you look at, this bank and you start seeing the kind of the digital world, right? So this is Silicon Valley Bank. And Silicon Valley Bank, just like it sounds, is based in the Silicon Valley, surrounded by tech companies. And so one of the main problems with new startup businesses is that it's very hard for them to get loans. It's very, a brand new company is a very risky proposition for a bank, because when you look at how a bank views risk, if a bank loans you money, their number one concern is, what do we get if this person can't pay us back? Right? What can we get? If they loan you money for a car, they can come get your car. If they loan you money for a house, they can come get your house. Right? But if you have a business, and let's say you have a business that's in a shopping center and you're renting your location from somebody else and you're selling whatever it is. Well, that's a bad loan for a bank, because really all they would have is your inventory, right? If you don't own the building, they can't come get the building. If you're, maybe they can come get some of the assets. What are they going to do? You got some tables and chairs in there. I mean, do you have anything? So that's a bad loan for a bank to make. So Silicon Valley Bank has really made their name with being very aggressive, loaning money to fast-paced tech startups. And one of the ways that they were able to do that, and very dangerous looking back on it now with hindsight bias, is that they would tell a tech company, we will loan you money based on what we think your IPO will be worth in the future. So IPO meaning initial public offering, meaning they're going to take their company public, list it on the stock exchange, generate a ton of money, hopefully, and be able to pay their loans back. Well, what have we had over the last couple of years? Well, with the stock market dropping basically since November 2001 until most recently, there have not been IPOs. So you look at the big companies, Goldman Sachs, Morgan Stanley, these big investment banks that really kind of underwrite these kind of companies. They're not taking anybody. There's no IPOs. There's no market for IPOs. Right now that you have interest rates going up, and you have all these tech implosions and crypto implosions and those kind of companies not doing well, nobody wants to invest in companies that aren't generating money or profitable. So a lot of their companies that they've been backing here have not been able to go public as soon as they thought they were going to be. So they've needed more money that they thought they would be able to generate from the public markets. And so because of that, Silicon Valley has started having a lot of withdrawals, right? These companies are taking out money. Maybe it's doing payroll. Maybe it's just general business. And so since 2020, Silicon Valley Bank had brought in a lot of deposits, right? When the federal government was sending people money, sending companies money, all the COVID stimulus money, they're shoving it into these banks. And so what did Silicon Valley do? Well, the Silicon Valley Bank started buying bonds, right? Which would not seem to be risky, government bonds, right? I mean, that would be something if you you go look at your finance textbook and it's telling you to do something safe. It says, hey, put your money in bonds. Well, the problem with that is something called duration risk. And it's a conversation I've had with my clients a number of times. Some of the people the other investment advisors that I talk to, we talk about duration risk. And so what duration risk is when you have interest rates that are very, very low and you take a government bond that's 30 years out. We'll see if we can animate this for you. But if you take a bond today, it goes out 30 years and interest rates start to rise, it's pretty amazing how much that drops the value of a bond in the future. So for example here, if you have a 30-year bond and interest rates go up 1%, that drops a 30-year bond's price by about 16%. Yeah, it drops the price. Because if you think about it, if I have a bond at 1% that goes out 30 years, and now you can get a bond that's paying 2% that goes out 30 years. Why would you want my bond that pays 1%? Well, you wouldn't. I would have to discount that. I would have to sell it to you at a discount. I'd have to put it on sale in order for you to buy it because you could just go get one for 2%. Well, when you have the government raise rates as fast as they did, that creates a lot of duration risk at the tail end, at the end of a 30-year bond. And it's one of the main reasons, like with my client base, the money that I manage, like I didn't have any of those bonds. Like I don't even want bonds that go out 5 years, right? Like, because if the government's going to raise rates, I want that money back as fast as possible so I can put it back at, a new rate. So going out 30 years for them was super risky. Now, in the beginning, it's not that risky. Because in the beginning, you don't have to actually change the value of that bond on your books. So that's the scary part to me is when you look at Silicon Valley's books, they didn't have to discount those bonds, right? Because they never had to sell them. Well, fast forward to today, when Silicon Valley Bank started having all these withdrawals, and then they have to start selling those bonds to raise money to give it to the depositors. All of a sudden, you start seeing how big a loss they're taking on those bonds they're having to sell out of, right? Because they're having to sell them at a discount. And it's billions upon billions of dollars that they're having to sell. Well, then you couple that with some big time Silicon Valley kind of OGs of the Silicon Valley putting out on Twitter that you should get your money out of this bank. And all of a sudden you have a good old fashioned bank run. So one of the guys who said, hey, you should take your money out was Peter Thiel. Peter Thiel, better known as the guy who helped found PayPal with Elon Musk. He also helped start Palantir. And he has a venture capital fund, venture capital. He's helping these private companies raise money to go public, helping, and so he's like, hey, you better get your money out of this bank. And so then you have people that put out on Twitter, hey, you better take your money out of this bank. And then you have what's called a bank run, which is people go and they start withdrawing money at a unbelievable fast pace, and the bank cannot keep up, and the bank cannot generate enough cash or assets to be able to pay that out. Because you have to think, when you give your money to a bank, they're going to keep a portion of it and they're going to loan out the rest, right? So the banking system is really based on trust, right? We trust that the bank is going to do well. We trust that the bank is going to have our money available to us when we need it. But if everybody that banks at a place shows up at the same time and says, we all want our money, then banks are not going to be able to pay all that out, because they don't build the bank on the assumption that one day everybody's going to show up at the same time within a 5-hour period and ask for all their money back. They just do not they do not expect that because they loan so much money out. So so we look at kind of these other regional banks, and we look at the Federal Reserve, and we look at people worried about these other banks. So what are the other banks? Why are we worried about this? Well, one of the things you've probably noticed over the past, 10 years is that when you look at your savings account, how much has your savings account been paying? Well, it's probably been paying like 0.01, 0.02 if you're lucky. And so with interest rates going up, banks have been like, we don't really want to raise that savings rate yet. We want to kind of be able to loan the money out for higher, keep paying a low savings rate so we can be more profitable, right? Because that's how a bank makes money. You give them money, they pay you a little bit on your deposits, in this case, an extremely low rate. And then they loan that money out, and they have what's in the middle called the spread, right? So they're paying you 0.01 on your savings account. It seems crazy, 0.01, and they're loaning it out at 5, right? So that's a 4.99% spread. And so banks here are getting a little greedy, trying to not raise your savings rate, even though a treasury, right, a 2-year treasury is going to pay you 4%. And that's an estimation. I think it's a little bit higher, but let's say it's 4%. So all of a sudden you have these savers go, wait a minute, why am I keeping my money here when I can do a CD over here at JP Morgan or Wells Fargo, kind of the big 5 banks, or I can just do a T-bill for 4%. Why am I going to keep this money in savings? And I've had this conversation with my clients. I'm part of this problem. Like, I've had this conversation with my clients over the last couple months. Like, I've had a lot of people that have moved, clients that have moved money over from savings accounts that we've put in CDs where they can actually make money. So I've definitely been having this conversation. And so what ends up happening is, especially with the small regional banks, is that the consumer has noticed, hey, I can move my money, I can move my savings money over, and I can actually get a yield somewhere else at 4%. And so these small regional banks are starting to have a lot of withdrawals. And I've even seen it in my own community. There was a bank in my community that would offer a CD to new customers paying, I don't know what it was at the time. I'm going to say 3.5% for example purposes, 3.5%, but you had to be a new customer of the bank. You couldn't be somebody that already banked there. And so, of course, I just think it's so dumb. So, of course, people who bank there see that, and they're asking for that rate, and they go, oh, no, you have to be a new customer. And so they're like, well, fine, I'm going to leave. And then they would take their money and go somewhere else. So you just can't treat your customers or expect them not to look for other avenues if those are the kind of things you're going to do. So, and remember, of course, this is for educational purposes only. So make sure to talk to your advisor about this stuff as well and get a different opinion here. But these are the things that happen. So then the Federal Reserve has to step in, because there's many tech companies that were banking at Silicon Valley Bank that had a lot of money in there, right? So one of them was Roku. If you don't know who Roku is, you know them, you just don't know you know them. So when you turn on your TV, a lot of times it has Roku built in. So when you hit the Amazon Prime button, you hit the Netflix button, you hit, the whichever streaming services, that's usually powered by a Roku system. They had $473 million in Silicon Valley Bank. And so the one thing that the Federal Reserve came in and said is that we're going to guarantee all of these deposits. So even though we know the insurance covers you up to $250,000, we're going to cover you above that. Because obviously $250,000 sounds good if you're an individual, but it doesn't sound good if you're a business, right? There's no way for a business to, who wants to bank at 53 institutions so that you can try to have FDIC insurance across the entire thing, right? You would have to have 3 people that are basically on staff, just moving money around between banks, trying to keep up with that. So it's definitely not good for businesses, especially small businesses. And the reason this is so scary is because small businesses employ most of the people in this country. And so if they don't feel like their banks are safe or that their deposits are safe, that becomes a real problem. Now, where could the silver lining of this lie for us? Well, the silver lining of this, and especially for your portfolio, could be that there's an old saying that says the Federal Reserve raises rates until they break something. And they definitely broke something here. And so this might come a time where the Fed is going to pause raising rates. They might raise one more time and then pause and see kind of what's happening, because there is a delay in what happens to the economy when you raise rates. I mean, there's a delay in rents and house prices and all this kind of stuff. So they might start to kind of see, hey, we're going to take a step back. We're going to see what happens. And by the way, the Fed is going to meet this next week on March 25th, and that will be the 1-year anniversary of when they started raising rates at this rapid clip. And so the silver lining could be that, okay, we got to pause here. We got to see what's happening. We need to make sure that nothing else happens, and make sure that the banking system is sound, because if the banking system isn't sound, there's really not many things that are worse. Now, I do not think this is like 2008. That was much different. I mean, we will see that the duration risk is serious, though, for a lot of these banks. I mean, if you hold your bonds to maturity, it doesn't matter. But if you have to sell them in the middle, it can be a problem, which is what happened to Silicon Valley Bank. That became a big problem for them. And so we just kind of need to see, not have all the answers here. But when you look at that, where did people go this week as far as putting their money? Well, interesting enough, one of the biggest companies that had one of the best performers this past week was Microsoft and Amazon and Google and Apple. And why do people feel safe in those companies? Well, those companies have a lot of cash. And those companies don't really need a bank. I mean, Apple's got over $100 billion in cash. They have extremely, extremely well capitalized balance sheets. So again, we see the same theme over and over again that we have to pay attention to. You have to invest in companies that are profitable or very close to profitability, that have good balance sheets, meaning they have a lot of cash, low debt, right? Because as debt goes up, and interest rates go up, those interest payments become a drag on the profitability of a company, right, on net income. And so you have to be sure that you're investing in good, solid companies. It is not the same as it was a couple years ago. A couple years ago, if a company thought they were going to be profitable or, thought they were going to have profits in the future, everybody wanted to be a part of them. That's not the case anymore. So you have to be very careful that you're investing in companies that are well capitalized, have a lot of money, and are profitable and will be able to weather the storm. Now, on the other hand, do I think this is going to provide you an opportunity to maybe buy into some of these regional banks that have been absolutely crushed over the past week? Yeah. And that's what I'm doing in my spare time. Nerd alert. What I'm doing in my spare time is actually looking at some of these banks that have been beat up down 60%, 50% in the last week and a half, and starting to look at, okay, which of these companies are going to do well, right? And it's kind of like when oil was down and nobody wanted to be in oil. You could have bought some really good oil companies, strong oil companies, and if you were just willing to wait. And now here we are again. There are going to be some of these regional banks that are going to do very well. Especially Silicon Valley, they filed for bankruptcy on Friday. Somebody's going to buy a lot of those assets. They're going to get the customers. They're going to get the deposits. Should be good for them. And so for now, it's me, basically looking at the balance sheets and making sure that some of these banks don't have the same duration risk that Silicon Valley Bank had. So we'll see, but that's kind of how all this stuff comes together. You really don't realize that somebody's being that risky. Silicon Valley, that's a very special situation with them loaning money to customers based on what their IPOs were going to be. That'll probably turn into some legislation at some point. Government people are going to be all over that. But again, based on where they're located, you can see how they could kind of fall into that as their competitive edge over other banks. Like, I mean, they're kind of, when you think about the time that they were doing that, where all these companies are going public and they're making so much money every year, 2 years, these IPOs are popping like bottle rockets every time they happen. And it just kind of, you kind of get you just kind of get into it, and all of a sudden you don't realize that you have so many that you've done that for, I guess. And it's real easy to kind of get lured into that, so, but I hope this is helpful for you. I hope that, just knowing how the banking system works and how these banks can kind of get into trouble. This is one of those kind of the risk of regional banks, because they're normally located in kind of the same type of industry because of the region, The same thing for me, like where I'm at based in West Texas, this happens to banks here where you have, the oil business, right? Instead of it being Silicon Valley Bank with tech companies, it could be oil companies. Oil goes to $19 a barrel, and all of a sudden you've made loans to a bunch of oil companies, and now none of them can pay it back. I mean, this can easily happen in different areas around the country when you have regional banks that have a very high they have the same type of customer base, a very high concentration of the same type of assets and the same type of customers. Because normally, like with the tech companies, no IPOs, it goes bad for all of them. If oil drops, it's bad for all the oil companies, right? So this kind of thing can happen just in any kind of region if an industry is really getting hit hard. So, but hopefully in the next couple of weeks, I can have some more information for you on some of the regional banks that I'm looking at. But that's it for this week, man. Let's hope for a calmer week, which we're not going to get because the Fed chair, they're going to meet on Wednesday. And so we'll see how that goes, and we'll talk about it next week. So one other thing I want to say, you probably noticed, or maybe you haven't noticed, but there hasn't been any Federal Reserve people talking about this banking crisis. The reason for that is because they have a 10-day blackout period before any meeting, and they cannot talk to the public. So it's almost like this has been a really bad time for this to happen, because when we've needed to hear from the Fed chair or some of the regional Fed presidents, they haven't been able to speak because of that blackout period. So we'll get to hear what they say this week. We'll see how it goes. We'll check in again next week, and we'll analyze it then. So I hope you have a great week. Don't mistake activity for achievement. I'll see you next time. Thanks, everybody.